morning, ladies and gentlemen. Well, another trading week goes by. We're nearly coming towards the middle of the year, and the risk dial continues to improve. Closed Friday at -19. We started the week, as we can see in the table here, at -23. And then improved to -19 and stayed there. On the weeklies, we can see the trend has been improving for the past 3 weeks together with price. It's always important to have a look at what the score is doing and compare it to price. But we still have, a negative trend here on the weeklies and on the monthlies. But on the monthlies, we can see how much we've improved from -90 to -19. It's not going to take very much to push the scores into a positive trend, but we are very, very much at difficult levels, which are swing levels, and basically the market keeps on doing nothing wrong. When the market keeps on doing nothing wrong, it's incumbent on us to actually find what the support levels are and actually not turn bearish until those support levels are undercut. Why they're going to be undercut, who the hell knows? All we know at the moment is that the Fed's QE is doing its job. The market is normalizing. Yields are extremely low, and I would argue that while yields are low, the probability of extreme swings and extreme risk off is not very high. So all we can do is identify inflection points both to the downside and the upside, and respect them, and only turn bearish once those are undercut. Deviations tells its own story, doesn't it? The market has managed to firmly turn around the middle line, which is now, all the way down to 27.70, let's say. That is going to be massive support, and you can see that the market, once it turns it, doesn't really test it for a long time, and this becomes absolutely fantastic support. I would argue that we are not going to see this level. We are probably not going to even see these lows for quite some time. And the upside, yes, we have upside all the way up at 3,150 in terms of SPX. It's going to be a very difficult time to trade. We have to identify some very important points. But before we do that, if we just have a look at what's happening to the various sectors, we will see that they are all turning upwards. It doesn't matter which sector you're looking at, whether it's XLU or XLI or XLF. All the sectors that have been weak are all turning, and the sectors that have been strong, like XLK, the prime mover, are not coming down. They're just going sideways. That is a recipe for a market which is stationary to strong. You can see here that XLF, as soon as it gets to the red area, backs off. Not surprising. XLF has been the weakest, but even that one has managed to turn things around. And even if XLF was now to retest the upward sloping center line, that is only a 3-4% move in the market. So what I'm trying to say is that it's unlikely that we will see absolutely big swings like we saw in February and March. The Fed is doing its job. Whichever sector we look at, the story is the same. XLV, I wouldn't be surprised if we made new all-time highs. There's a lot of market rotation under the hood, and the market rotation is actually giving the market stability, the SPY stability. So when XLK stops leading, XLY and XLI start going up, just like I showed you last week. And this sector rotation is actually maintaining the stability of the market. Bond market is really not giving us any clues at the moment as to where the big price movement is going to be in the next week or so. The yield curve, 2s10s, is absolutely stable, keeps on trading with a high of 53. And basically it's 53.48 what you want to do. I still look at these levels as very important, 36 to 30, and anything above 53 will tell me that the market is really going into a some kind of a risk-off phase for the time being. I can't imagine why the yield curve would sustain these levels at the moment, but you never know. It's what it is. The bond market is really not giving us any clues. It's actually telling us that the likelihood is for a steepening of the curve. Why would the curve steepen? Inflation fears, supply concerns, all sorts of things which I don't think are likely to make it move substantially in the next few weeks. And that tells me that the volatility of SPY is also going to be subdued. If we look at the 530s, they're giving some pretty strong indication, or starting to give some pretty strong indication, that the yield curve is definitely going to keep on steepening. You know, I would not be surprised to see it at these levels by year end. You know, minus 155 basis points. So, sorry, positive 155 basis points, because this is an inverse structure. You will see from all my previous videos that one of my central tenets is that this is a buy everything market, and that the bond yields are the main reason why equity prices keep on going higher. You know, you just keep on getting a higher multiple discounting the 2021s and 2022 earnings because bond yields are so low. If bond yields now start creeping up and the yield curve starts steepening, that might be good for certain sectors like XLF, but it's bad for other sectors like XLK. It's bad for all sorts of other sectors like XLP and even XLY. So it is unlikely that a steepening yield curve is supportive of the stock market under current conditions. Normally, a steepening yield curve will show you that you are in risk on. But we are unlikely to be in risk on until the economy starts improving, and we are a long way away from that. The reason why things are where they are, why SPY prices are as high as they are, is because the multiples are as high as they are, and they are high because bond yields and the long end of the yield curve is so low. If the long end of the yield curve, even though the Fed might use all sorts of things like yield curve control to control 1 year, 2 year, 3 year, 5 year prices, if they lose control of the 30-year, I will bet my bottom dollar that the SPY will be lower, not higher. It might, it might hold out for a few days or weeks, but it's not going to hold out forever, simply because multiples are the things that rule the roost here. If we keep on going down in the 530s, you will see a risk market that is under pressure. This SPY TLT chart is actually one of my favorites at the moment, and I'm looking at it all the time. We got into this center area between 1.9 and 1.83 that I told you would be very, very important last week, and that is where we would get to if the market wanted to be bullish. We've absolutely got it, and now it's at the 50% retracement basically of the whole move from February, and this ratio is all important now. If we start breaking above 190, we are in pretty damn strong risk on. I don't know why that would happen, but I'm open to all possibilities here, simply because the market has been defying all the all the doomsayers for such a long time. I was never one of those, but I am now saying that the market is fully priced. But again, it's not doing anything wrong. Just because the market is fully priced does not mean you cannot get more fully priced. And I would really like to see a move back below 183 before I get too bearish on risk. But even then, I would argue that all we're going to do is go back to this kind of line, or maybe this kind of level. So we are talking about fairly contained moves. We're talking probably a move back to 29.54 or maybe 28.64. We're not talking about the tens of percentage points that we were talking about here when we broke down and kept on going down. We are in a consolidation period, and I would say that this is a direct result of the Fed action, which has been extremely successful. So here now we are arguing, do we go back to here, i.e. the 38.2? You can see how well the market has bottomed there around the 175. That would probably give us 2900 to 2950 in S&Ps. Or do we break up and go to the 200-day moving average and this 0.618 retracement? That will take us all the way up to 3150 or so. If I look at gold to give me any different clues about risk, I'm really not getting any. 1668 is the first level below which I can get even bearish on for a day trade. But you have such wonderful support from these moving averages, which are turning. Don't forget, this is a weekly chart. That I really don't see anything but a buy the dip kind of atmosphere here in the gold market. As close as you can get it to 1668, and basically it's just a hold. It's saying that the relationship between bonds, the US dollar and gold here is fairly stable, and unless we see some big moves in the US dollar or in bonds, we are unlikely to break out of this trading range between 1700 and 1800 and just consolidate here for several more weeks. But let's have a look at the dollar and see what that is saying. It's absolutely obvious that the dollar had a negative week last week. This is a weekly chart and this one is a daily chart. We've come from one important level at 99.83 to another important level at here it's more precise 98.33, and basically we just bounce in between levels. The dollar, I would argue, is acting as a shock absorber, which is one of its main roles. We closed right on top of the 200-day moving average, just as we closed very close to the 200-day moving average in S&Ps. It is really a trading market. It is not trending in the slightest. We have our very important support level at 96.47, and until we start turning this 200-day moving average, I really wouldn't get very bearish whether we buy it to 98.33 or we wait for 96.47. Who knows, but I don't think we'll see 96.47 even next week. Certainly at that level it's a better buy than sell. because if we start closing below it for a couple of weeks, we will probably start getting into trend. But I don't see that as a huge likelihood. The differentials between bond yields are very stable. It would have to be an exogenous factor that comes in, and certainly that is unknowable at the moment. It is unlikely that we break out of this huge area of trading between 96.47 or so and 99.79, in which we have been for 90% of the past couple of years. I have seen lots of comments about silver, how it's the next, I don't know what, Bitcoin. I really wouldn't get too excited. I have some very firm levels in silver, which is 1620 for the dip, and below it it's bearish, and above it it's a trading range up to 1870. And if it starts breaking that on would like at least 2 weekly closes above it, this is a daily chart though, then we can start looking to the upside. At the moment it's basically stuck between 1870 and 1620. I see no reason why an industrial metal would do much better. Basically the basis against gold keeps on swinging in and swinging out, but that does not a trend make. I would argue that we are pretty damn toppish here in silver, and it's more likely to retest the 1620 level than break the 1870 and keep on going. I'm perfectly willing to be proven wrong, and if I am, I will adjust my views accordingly. But to me, this is not a bullish chart for the time being. Before I cover risk in detail, I just wanted to show you these charts, which I think I showed you last week, which is XLI over SPY and XLF over SPY. It's amazing. This is, these levels have been in here for forever. So certainly for several weeks. And where did we back off on a couple of days ago on Thursday? Right at that ratio. And then you tell me that these spread relationships don't matter. Of course they matter. To me, XLF, the only reason that XLF can go positive relative to SPY is that we have a stronger economy, that people are starting to discount a much stronger economy. How will we know that we are in, and I would argue that we can't really be in full strong risk on until XLF starts recovering against SPY. If the banks are in the doldrums, that means that credit is relatively weak, that means the balance sheets are weak, that means that there is credit impairment, or that the market foresees continued credit impairment. That cannot be good for risk, and we will only have true risk on, I will say now, if we break this level in SPY relative to XLF. Here we have a daily chart of the S&Ps and also one of VXX, just to see what volatility is doing relative to the market. Now, what is interesting here is that if we look at this day, which was the 28th of February, when we made this first low around the 28.64 area, and then we had a considerable bounce, is equivalent to this day here, when 228, when volatility was at basically 25 in the VXX. We're still considerably higher, while here we have busted it by a long way, haven't we? What is that telling us? Well, it's telling us one or two things, I think. Nobody wants to sell volatility because they got so badly burnt, and all the funds that used to sell volatility for a living actually are out of that game, and therefore volatility remains higher, even though the market is recovering much better than volatility would suggest, or it's a very, very important tell, and that the market at these levels is unsustainable. I don't know which one will win. I'm just saying that this is the, this is the state of play. My favorite would be for the market to do very little here and actually for volatility to come down and start testing the 200-day moving average of the VXX around the 26 level. 2542 has always been a very important level to me, and here we go. I think we will test it in the next several weeks. I'm not a buyer of volatility. I think volatility is just too expensive relative to what we're likely to get. The Fed's intention is to dampen volatility. I'm not going to fight the Fed. I'm going to go with it. I think volatility is a much better sell than the S&Ps are a buy. Just as simple as that. But in any case, here we have every single important level. Last week, I really did not think that we would be able to break the 3028 level and sustain it. I was proved wrong on Friday when, it really squeezed into the close and closed at 3044. Not a big move, but, and it looks like it's going to reopen in a few hours' time, right around that level. But what I'm trying to show you here in this very simple chart with all my levels marked is that the market is doing absolutely nothing wrong. It breaks 2954, it breaks 2864, it comes back and retests those levels, it holds, and it keeps on going higher. Basically now we have this support at 2954 and then 2864. I would be shocked if in the next couple of days we are below 2954, and I will be utterly amazed if in the next 2 weeks we are below 2864. I think those are now very, very good support levels. If the market decides to get the bit between its teeth, we have 3120 and then very little all the way up to 3214. Now if we get up there, I will be shocked again, just like I was shocked when we broke 3027. But what I'm really trying to say is let the price action decide when the timing is for any bigger move. I would definitely be just like I was a buyer at put spreads at 30.28. I will be a buyer of put spreads again at 31.20.22. It's just in my nature to try to respect levels and let the break of levels tell me that something different is going on. From a weekly perspective, we can see that the retracement, and whoever thought we'd get here, the 78 and 76% retracements are right around the 31, 10, 20, 30 area. But this candle to me is quite important. The fact that we broke 30.28 and there was absolutely no reason to break it. It's not like we had intensely bullish news. Is telling, it is telling. All the weekly moving averages are turning and giving support. I would argue that now, unless we start breaking this 29.55 level on the downside, and you can see here, I'll try and enlarge this chart even more for you. We have 29.55 being very, very important. This moving average will probably be there, when we open for the new week. 29.55 now becomes very, very pivotal. I reckon that unless we start breaking 29.55, eventually we will trade up to these 31.36 kind of level, 31.25. Maybe we have a couple of weeks more of sideway action just to get everybody confused and then break up. But as long as all these moving averages are turning and there is no pressure below the 29.55 area, I have to respect what the price action is telling me, and the price action is telling me, buy the dip, and the first really important dip is 29.55. Europe, as I told you last week, is saying much the same thing. We got to the 11,700. That was, my first objective in the DAX, and we got to 30.85, which was my first objective in the stocks. If we now start breaking up above those levels, what can I say? It's just not bearish. It's not like we backed off a million miles in either of them. It's not like we had a negative weekly candle close. To me, this is saying that the market is still maybe stuck in a range, but is definitely supported. There is no pressure that is not being alleviated within a few hours or a couple of days. If we now start going and closing below 28.90-ish in the stocks, and I would argue somewhere around here, 10,700 in the DAX, even after a couple of weeks of consolidation, which might coincide with the S&P trading down and being supported at 29.55, the path of least resistance still seems to be up. It's unlikely that we don't see at least this kind of level. I would argue 32.40 in SPX, let's call it 3200 between friends, and maybe even this kind of level, 12,400 in the DAX, before these markets are exhausted just as much, and the other risk markets are exhausted. It seems to me that at the moment Europe and Japan are probably taking the mantle of leadership from SPY, but that doesn't mean very much just because they are up 0.5% more than SPY. I mean, so what? I'm just trying to give you an overall picture that nothing really at the moment is saying that we are about to turn into a huge bout of risk off. The Nikkei, again, doing nothing wrong. Look at this wonderful, beautiful close on the candle, on the weekly candle. You're not going to tell me this is hugely bearish. Yes, it's got resistance around here, around these levels. 22,130 is, decent resistance. It had, weekly resistance there for some time. But I think the really important line is here at 23,005. This is going to be very, very difficult to break. I mean, almost impossible for a long time. I mean, the market has come from 15,500 all the way up to 23,000. That is very difficult to break. And that also tells me that volatility is going to be rather subdued for a period. So that is why I think my idea of selling volatility rather than selling the market, rather than buying the market in risk, is probably a better idea for the time being. You will probably lose less money being short volatility than you will being short the market, as it were. But here it is. None of these charts are bearish, and until I see certain levels broken, and these gaps being negated, I just can't turn bearish. I am not particularly bullish at these levels, and I've told you why. I think the market is expensive, but I am not going to start getting short as opposed to just a few options, few put spreads. until the market gives me some timing. This kind of candle doesn't really give me any timing at all. Might change next week, might not, but I'm not prepared to anticipate it. And the last reason why I really can't get very long of the market, but I can I can buy put spreads, or I can sell volatility, or I can sell some out of the money puts, is because our friend the NDX is still above the monthly Bollinger Band. It does that sometimes, it stays above a bit, but it always comes back. It always comes back, which tells me that we are in a range. If NDX doesn't lead, and certainly if XLY doesn't lead, and I explained to you why it would lead if the economy is doing better, then I can't see the SPX, doing a moonshot, but I also certainly can't see it falling back below the very important level of 29.54 and then 28.64 below that. While we are up here, and okay, we will go, we will open the new month on Monday, and this Bollinger Band will be slightly higher, probably somewhere near the all-time highs. But while that is the situation, I really can't see the reason to get too bullish of this market. And if you can't get too bullish of this market, then it's much more likely to do one of these consolidation things at least this level, and keep on coming below 94.50 or 94.10 or whatever, and bouncing off something like 9,250. It's just not going to keep on going, not through the monthly Bollinger Band. That is very, very unlikely. Okay, thank you very much indeed, and tweet you on Monday.